my background is really my whole career almost been dealing with disruptive innovation. It's kind of become a bit of a family business. My dad is the guy who coined this term about 25 years ago almost in his doctoral research. Lay out this framework of disruptive innovation. I'm sure a lot of you have heard this term before. My guess would be, at least if your experience is anything like mine, somewhere between 95 and 98% of the time you hear it, it's not used properly. At least in the context of how this principle, disruptive innovation, was defined in the academic research that my dad did. And so what I want to start off by doing is just in a very kind of methodical fashion, go through and tell you where did this idea come from, and then how do we define it. And so this framework of disruptive innovation is really what emerged as the explanation for what causes successful companies to fail. And so I'll start off by just pointing you to this diagram in the top line on that chart that's supposed to look like it's in the back. And so this line reflects what we call sustaining innovation. And I'd say that over 70% of innovation, maybe over 80%, kind of fits this category. And we call it sustaining because it perpetuates a path of product or service improvement that has historically been in place. And so whether you're making a small and incremental improvement, like, at these breakfasts we used to only have water, but now we have orange juice and coffee and other things, innovation, that improve the product or service offering a little bit, or radical huge breakthroughs, like in signal processing, the evolution from analog signal processing to digital signal processing to optical signal processing, for which people literally won Nobel Prizes along the way. As long as these innovations help you continue to sell better products and services to your best customers for more money, we call them sustaining. They sustain the path that you have been on previously. And if your ambition as a new entrant into that business is to leapfrog ahead of the incumbents and build a better mousetrap, they'll destroy you. Because they're already working on this. The things that they do well, that got them into this position in the first place, are the things that are going to matter in continuing to do that. They have fantastic relationships with suppliers, with customers. They employ great engineers. R&D is clicking. Marketing, they know what people want before they know it. They have great sales guys who go out and they're sharks. They go out and close. They know what. They have all the right golfing buddies, you name it. And as an entrant with limited resources, you have almost none of those things. Even if what you're doing is better, you know that the guys you're competing against are working on that same thing, but they're just better resourced. It's very hard. In fact, my dad got some great advice from a good friend when he started his research on this stuff. They said, study the disk drive industry, hard disk drives. Because that's the equivalent of the fruit flies in the business world. They live and die so fast that you can get good population data on what happens there. So there's a resource, an industry resource called Disk Trend Report that has literally information from a performance perspective and from a financial performance perspective for every disk drive that has ever been sold in the world. So you can run your analysis on that and you don't run into sample problems, you have full population data. From that, what he found in the disk drive industry, and I think directionally we could generalize this, is that if you try to leapfrog ahead of the incumbent guys, the probability that you'll succeed, and he defines success as 1 year of $100 million in sales or more. So more years of $100 million in sales or 1 year with more than $100 million in sales. Probability is 6%. Pretty dismal. I think very few of you would be excited about engaging in something that prospectively had a probability of success of 6%. That's worse than if you're familiar with the sorts of returns that people get in venture capital. Really the way that industry works is that 1 or 2 out of 10 investments do great. 3 or 4 of them sort of return capital, and the rest end up zeros. 6% is even worse than that. So it really is the incumbent companies who we would expect should succeed in the sustaining environment. There's this second category of innovation that we call disruptive innovation, and you can see here below that top line, there's kind of that hooking arrow that points to the line right below it. And I'll get to these two variants in a second. But basically what we see with disruption is that there's a compromise along some measure of performance that has historically been most important in an industry, where the entrant, instead of trying to do better, build a better mousetrap, says, you know, this is going to be a worse product based on how you've historically evaluated products like mine. But I'm going to, by having it be worse, gain some other attribute that allows me to target a new category of customers, or the low end of an existing market that I know that the incumbent guys are uninterested in serving. In the mini computer industry that I referenced earlier, what that meant was that personal computers came along, and they were affordable to the point that families could buy them. So historically, a mini computer cost somewhere between $400,000 and $600,000 bucks. And there was really nothing that the Christensen family could use a $400,000 to $600,000 computer before, because we couldn't afford it, and even if we could, you couldn't play video games on it, so what good was it? But when the IBM PC Junior came out, or the original Commodore, or the Apple II, those things actually were great for that. They cost 2 orders of magnitude less, thousands of dollars, not hundreds of thousands of dollars. They had all kinds of great video games on them. And they also had the drawback or the virtue, depending on how you're looking at it, of not really being able to do anything that a customer of digital would use a computer to do. So our first computer was an IBM PC Junior. It was so flimsy that to boot it up you had to insert a cartridge, like a video game console, to have DOS. And if you wanted to mess around with DOS or BASIC, you had to plug in cartridges. It also had a 5 1/4 inch floppy drive. But no matter what, you had to save everything to the floppy. Its word processing software, I don't remember the name of it, but it maxed out its file size at 6 pages. So if you write an 8-page letter to grandma, you got to save it in letter to grandma 1 and letter to grandma 2. Just there's nothing about the IBM PC Junior that would be interesting to the customer of a mini computer manufacturer. So it's just net new growth. The Christensens buy PCs, so do our neighbors. But if you look at the customers for digital, those guys, it's not even on their radar screen. So if you put yourself into the shoes of a middle manager at digital, you can imagine that in the morning somebody comes into your office and says, I have a great idea. We should build better mini computers to compete against the mainframe guys. I don't know how many of you remember all these things, but mainframe would fill a room, be bought by General Motors or the Department of Defense. A mini computer is the size of like a refrigerator, a lot smaller, cost somewhere between 1 or 2 orders of magnitude less, so hundreds of thousands of dollars, not millions or tens of millions. And it would be bought by small and medium-sized companies that needed to run spreadsheets mostly. And then PCs you're familiar with, again, far cheaper. Somebody comes into your office in the morning and says, let's compete with the mainframe guys. If we really kind of crank on R&D, we can come out with better computers that we could sell for, say, $600,000 to $800,000 bucks. Now, I have this huge report that I've put together that's built on information from who our competitors would be. Silicon Graphics, IBM, Cray, they're public companies. So this is very reliable information from their filings with the SEC. And we can leverage our existing sales force. Our guys are great. They're already trying to talk to some of the guys at GM and GE and Northrop Grumman and so forth. So we don't have to incur any cost. We just sort of leverage all this stuff and it just falls to the bottom line. So you kind of hear that and you think, well, seems like a good idea. So you tell them, good job, I'll take a look at it a little bit later in the day. That guy walks out. After lunch, another guy walks in and says, hey, personal computers are the future. Someday, everybody's going to have one of these in their office and one of these in their briefcase and one of these at their house. It's going to be huge. And you ask, well, Okay, what does a PC sell for? Well, $4,000 or $5,000, and the price point's falling pretty fast. But you'll make it up on the volume. Well, how are we going to sell these? Can our sales guys go out and sell these? Sales guys who are making $250,000 a year? Not really. The unit economics don't really justify that. So we probably have to sell it through retail. Okay, well, who sells PCs at retail? Well, nobody yet, but they're going to want to. It's going to be huge. It's tough story to believe in. And what's punishing about it, and this is why the first book that my dad wrote about this is called The Innovators Dilemma, is that even if you believe the story, there's not a lot you can do about it. Because digital has a cost structure that sort of requires the 40% gross margins that come from selling mini computers. And so if you start to sell something that has, say, 20% gross margins that you have on PCs that are falling very quickly to single digits that you have now, you just can't get there from here. And so even if you believe it, there's not a lot you can do about it. That's a dilemma. And so this is kind of the perspective that first book was written by. It was kind of interesting, just a little historical quirk. The Innovators Dilemma came out in 1997, just at the start of the first kind of tech bubble. It actually makes no mention of the internet. It's not something that at the time we were really familiar with, and yet it was the emergence of the internet that sort of drove the impact of the book. So the second edition has a chapter at the end about the internet. But originally, it's just not part of it. I think this is a phenomenon that is sort of robust and applies across the variety of industries. Matt and I were talking about newspapers a little bit. Newspapers is an example of an industry that's gone through a lot of disruption. So there are two categories of disruption. One we refer to as low end. And for a low end disruption, really what you're doing is that trade-off that I mentioned you're having to make and having an inferior product, you're doing in favor of something that is lower price. And I'll go through a case study of what that, kind of in our mind, the classic example of that in a second. But the other example is a new market disruption. And there, what you're doing is you're offering something that's simpler or easier to use to a new category of customers. So kind of like the PC just brought net new growth into the computing industry by targeting families. So other new market disruptions do the same thing. I mentioned that I would talk through an example of this low-end disruption. And the kind of archetypical example in my mind is this example of steel mini mills. Any of you ever been to a steel mini mill? 2 guys, 3, 4. You guys describe what that's like? You've been inside?
It's a lot of smaller processes. It's not one sort of giant mill, if you would. And a lot of scrap metal going into it.
Right.
It's like a salvage yard.
Yeah. The feedstock comes from salvage yards.
Right.
Yeah, that's right. So historically, up until the mid-60s, we've got dates on here, I guess I could look at that. Up until the mid-60s, all of the steel in the U.S. was produced from ore that would go into what are called integrated steel mills, run by like Bethlehem Steel or U.S. Steel companies like that. And they have these huge open hearth blast furnaces that you dump the iron ore into and coking coal and other things to get steel out the other end. Now, a lot of the downstream processes require a really substantial scale, so it's called an integrated mill because all these pieces kind of need to fit together. And an open hearth blast furnace is probably roughly the size of this room, not this shape, but about this size. In the 60s then, a new technology emerged that used an electric arc furnace. An electric arc furnace, the actual furnace probably would go from the near end of the screen to the edge of that door. It's a lot smaller and uses a lot less electricity in a lot less power in a completely different fashion. And as this gentleman mentioned, uses scrap steel instead of ore. There's sort of a problem with that, at least initially, which is it's scrap, and since you didn't make it, you don't know what went into it. And so you kind of end up literally with garbage in, garbage out, where you don't know what you're putting in, so you can't really say much about what's going to come out. So when companies first started to commercialize this mini mill technology, they call them mini mills because they're smaller, they could only make rebar, because that's the lowest quality standard steel that you're able to produce. It also is sort of the most commodity tier of the steel industry. Because it's so low quality, there's no real skill required, and kind of anybody could do it. One of the nice things about the mini mill business model is that it has a 20% cost advantage relative to the integrated guys, and part of that's because you're using scrap instead of ore, and part of that's because you don't have to have the flexibility or the capability to do all the other kind of tiers of the steel industry. So there's rebar, and then there's angle iron, and bar and rod, and then structural steel, and the high-end, most profitable tier is sheet, like goes on appliances and cars. So companies like Nucor are sort of reflective of the mini mill companies. They come in at the low end, and as they enter, just able to make quality of sufficient, or make steel of sufficient quality for the low-end market there. Now, how do you think U.S. Steel and Bethlehem and other guys react to that entry? Are they terrified that there's this kind of startup operating in Gary, Indiana, and Alabama? No, right? They look at these guys and they think, why on earth would you ever want to make rebar? If you guys knew what you're doing, you would want to make sheet. But you don't know what you're doing, because these customers are horrible. They're not loyal. They don't realize how impressive our steel is. These are terrible customers. You've heard the term, like fire some customers, right? These are the customers we would fire if we didn't kind of need this slack capacity to fill up our integrated mills. So tell you what, you can have them. Because by the way, we can just stop doing this rebar stuff that has 7% gross margins, and we'll reconfigure that capacity for angle irons and bars and rods. It's almost double the gross margin at 12%. So there's sort of this interesting asymmetry where there's an incentive for Nucor to get in. You know, a lousy business is better than no business. So for Nucor, it's an interesting opportunity. And there's an incentive for the incumbent to get out. So they look at this and they're like, well, if I had to trade a rebar customer for an angle iron or bar and rod customer, I would do that all day long. And it seems like these guys are helping me make that decision. So incentive to get in, incentive to get out. Everybody seems really quite happy. Until, in the late 70s, early 80s, finally, Nucor and its other cohort of mini mill companies like Chaparral have succeeded in pushing the last integrated steel mill out of the rebar business. And then, can you guess what happens? It's kind of counterintuitive. They don't teach you this in business school, but it ends up that a low-cost strategy only works when there's a high-cost competitor. So as soon as the last integrated steel mill gets out of the rebar business, prices fall by 20%. Because then it's just low-cost mini mill competing against low-cost mini mill. Nobody has a big advantage other than to compete on price, because it actually really is a commodity. So the marginal price goes to the marginal cost of at least the finished manufacturer, and all these guys are efficient, so price comes down a lot. So perversely, the sort of the reward for success is subsistence.